Earlier this year, the president gave a State of the Union address, and he said that anybody that was not believing the economic recovery was peddling fiction. And these are some of the headlines that have been coming out about the economy over the course of the last several months. Now, as somebody who looks into the economic data beyond the headlines, I find some of these headlines troubling, only from the standpoint that the headline economic data seems to not actually correspond with what is happening in the real underlying economy. I just heard an interesting statistic last night as I was driving home. I was listening to the radio, and they were going through a recent article that was out in the Wall Street Journal talking about the number of individuals in this country that are now claiming some form of Social Security benefit, either through Social Security disability or just actual Social Security payments. 60 million claimants now on Social Security of some form. Now, this doesn't mean people that have retired. This is anybody who has filed for Social Security either through a dependent status, a death of survivorship status, or somebody claiming disability, as well as individuals just simply have retired and now are taking their Social Security. 60 million, it's a record high. Now think about that number for a moment, 60 million. How many people in America today are working a full-time job? Actual numbers. 120 million. That's about 125 million to be exact, but let's just make easy math. You've got 2 people paying in to Social Security for every person that's taking out. That number is going to shrink over the next 15 years. There will be more people actually taking out to where we're going to have almost a one-to-one relationship between the number of people contributing to Social Security versus those taking out. This is why the Social Security Administration itself says that by 2025, they will only be able to pay out 70% of their benefits. It's a function of math. But let's talk about this economy. I digressed. If the economy is growing, as the headlines suggest, would that not mean that more people are working and generating an income? Should. This is the number of people, this is the amount of money when you look at somebody's disposable income that is coming from social benefits, some form of welfare. Currently, social benefits as a percentage of disposable personal income is the highest level on record ever in history. Gallup last year came out with a study, and they studied American families all across the country, and what they found out is that to raise a family of 4, it costs roughly about $53,000 a year. Now, the issue is, I have 4 kids, and I don't know how on earth somebody can actually support a family of 4, much less 6, on $50,000 a year. The cost of school and insurance, and they're eating me out of house and home. It's just a function of money. So it's pretty amazing that, in America today, people can actually raise a family of 4 on $53,000 a year. Here's the problem. This is the median income for those same families that are raising a family of 4. The gap between what it actually costs them to raise the family of 4 versus what they are bringing into the household to live on has fallen over the last 8 years. Now the question is very simply, again, if the economy is recovering so well as we are told by the headlines, if those who are denying the economic recovery are peddling fiction, why does that chart look like that? By the way, I did a study just the other day on looking at the income run of all quintiles of America. 80% of Americans are below that line of $53,000. Only the 20% of Americans at the top of the top income bracket, and primarily those in the top 1%, are above that line. This is not surprising, of course. When we take a look at those stats about incomes and the number of people on social benefits. If the economy is actually recovering, then why do we have the largest number of people who are no longer counted as part of the labor force? These are people that are sitting outside the labor force. They've been out of work for more than a year. They have basically given up looking for work, and they are simply no longer counted. Now, if we don't count somebody, let's just assume this number for a second. So if we take a look at the number of people who are currently no longer counted, that's roughly 93 million people. We have 160 million people that are counted as employed and part of the labor force. So let's call it 180. Let's bump it up some so we can just have a 50-50 split. That means that from this middle of the room over to this side, y'all are not counted as part of the labor force. So apparently y'all don't need to eat. You don't need to have a house to live in. You no longer survive. You no longer exist. We just simply don't count you, but yet this half of the room is still taking income from social welfare benefits. They're still a part of the food stamp problem. They're part of the overall economy. And this is why when we take a look at economic growth, we can't get past about a 2% run rate. So here's some stats for you. Now, these stats that I'm about to show you, the Federal Reserve does a tri-annual survey on American families. And the stats I'm about to show you are from that tri-annual survey. Again, President Obama says, if you don't believe in the recovery, you're peddling fiction, market's up, obviously the economy is doing well. I want you to take a look at these numbers. 93 million people no longer count as part of the labor force. 80% of the population currently living paycheck to paycheck. This chart that's up here and it shows the number, this is the income wage over the amount of income that people receive and that they're working on. Now, is that going up or going down? 1 in 4 Americans on some form of government assistance. We have the highest level on record of 70-plus age individuals still in the labor force. I was just talking to a gentleman earlier. He just retired. Great job. But we have more and more people today that simply can no longer afford to retire. Equity ownership. Equity ownership is entrepreneurism. In other words, people that went out and started a business. People that have gone out and created a job. When you look at the number of corporations in America, there's about 23 million filed corporations. Anybody want to take a guess? Out of 23 million filed corporations, how many of them actually have an employee? About 6 million. Out of those 6 million, almost 80% of those have fewer than 5 employees. The backbone of America, the American entrepreneurship, the American dream, going out and creating a business and starting something to raise your family, they are primarily mom and pop shops all across this country. They are your dry cleaners on the corner. They're your grocery store. They're your gas station at the gas station right around the street. Those are the people that make up America. Those are the people that are generating an income. Those are the people that are having to deal with the regulations that come down from the administration. They're the ones having to deal with higher health care costs. Is it any surprise that the number of small businesses in this country are on the decline? Now, I want you to remember that stat because we're going to come back to it because it's an extremely important point that we're going to talk about in a few minutes in terms of overall employment. Household net worth is lower today than it was in 2007. Wait a minute. Stock market's going up. Stock market's up 200% since 2009. How can household net worth be lower? Y'all are a lucky few people here. If you're here, you're interested in the economy and you're interested in your money, which means that every one of you here are in the top 10% of the country. Because the bottom 80% have no money to invest. Recent studies by Bankrate and several other polling firms have shown that 63 to 73% of the economy, depending on the study, cannot find $500 to meet an emergency. They cannot pay a $1,000 emergency room bill if they had to go to the emergency room. They are basically just making ends meet, which is it really any surprise when we go back and look at the amount of money needed, again, to raise a family of 4 versus what they actually have coming in income. There's just simply no slack. There is no excess. That last chart that's on the steep decline there, the one on the right-hand side, stock market's up 200%. That line is going down. That is people's investments into stocks and mutual funds, the value of it. Stock market may be going up for the people who are invested in it, but for a large majority of the population, they don't have anything invested. They can't contribute to 401k plans. There's simply no extra money. Okay, so I told you about, keep in mind about this small equity, small business equity ownership, entrepreneurship, owning equity in a business that you started. How many people here are small business owners? Yeah, me too. A lot of you. Here's what's interesting. So if you look at the green line, that's showing you the shares of businesses, of firms that are less than 1 year old. It's just plummeting. And the red line is the number of firms that are dissolving, which is going up. Combine those two together, it's not a pretty picture. Now, here's the interesting thing about this. So, one Friday of every month, we have the employment report. How many people believe the employment report that says we've been creating 200,000 jobs a month? Okay, I just want to make sure it wasn't just me. That's it. Because once a month we get something, oh, we created 220,000 jobs this month. That's awesome. Okay, we did create jobs. They were mostly bartenders, waiters, leisure, hotel workers. There's nothing wrong with that. They're all fine jobs, but they're in the lower wage paying sector of the economy. Again, going back to why we don't have rising wages, we have declining wages. But contained within the employment report is this little adjustment that the Bureau of Labor Statistics throws in. It's called the birth-death adjustment. Anybody ever heard of that before? Okay. What the birth-death adjustment is an estimation for the number of businesses that have been created in a month. So Richard, he says, you know what? I'm going to go start my own company. He goes out tomorrow, he files a DBA or he files an LLC, and he hangs his shingle on the wall, and he says, I'm an employee of my own company. So theoretically, there's been a business started and an employee's been put to work, and that's added to the payroll number. But wait a minute, that doesn't make any sense, because if we look at this chart right here, it says that since 2009, the number of businesses that are being started and dissolved are falling. Gallup did an interesting study. They said that on average, since 2009, we have lost 70,000 small businesses a year. Now, wait a second. If the Bureau of Labor Statistics is adding numbers to the employment roll every month versus the statistics that say we're losing small businesses every month, it's a problem. Here's the employment numbers. This is what the Bureau of Labor Statistics says is the gross number of cumulative job gains since 2009, including the birth-death adjustment. Okay, now if we go back to that previous chart, I said that we're actually losing businesses every month, right? Okay, let's just say we had no business creation. Let's be optimistic. Let's just say it's been flat. So let's just take out the birth-death adjustment, which is still going to overestimate the numbers. Whoops. And this is what it looks like without the birth-death adjustment. Here's the issue. According to the BLS, they've reported that we've created a cumulative number of 9 million jobs. Subtract out the differential, and there is almost a 4.5 million job difference between what the Bureau of Labor Statistics says is employed versus what is actual employment. And like I said, it's actually even worse than that. That is still an overestimation of employment. Now, this also makes sense. If we come back and start thinking about wage growth, the number of people with assets in the market, declining business equity, all the things I just showed you, that makes sense. It completely makes sense, and it aligns with what the data says. Okay. Also, if the job market and employment was improving to that degree, does that really look like 4.9, actually, as of the latest report, does that really look like 5% unemployment in the country? That's the number of people between the ages of 16 and 54 that are employed as part of the labor force. Now, the reason I stopped at 54 is because, according to the Federal Reserve, all you baby boomers are retiring. So I just said, look, let's take everybody out over the age of 55, and let's just look at people between 16 and 54. Those are the ones that should be working. They should be having a job. They should be raising a family. They should be doing all the things to help support economic growth, but you have that problem, which is why you can't get above 2% economic growth. So that's the problem economically, just from the surface. That's the 30,000-foot view. In 2007, I did the same presentation. By the way, this is my first seminar that I've done in 4 years, so I apologize if I'm a little rusty. In 2007, I did this very same presentation to a degree, a little different, but primarily this. And I was warning then that we were very close to entering into a recession that was probably going to be as bad or worse than the Great Depression. And at that time, I went through a series of charts explaining why I thought that was going to be the case. So these are the same charts today that I looked at back in 2007. So as we take a look at these issues, and we look at things like personal consumptions versus imports, imports are an interesting item to look at because imports are not just oil. It's everything that we import, televisions, phones, you name it. Whatever you buy from overseas that you have shipped to your house via Amazon, that's an import. We import that. So if the economy is growing and people are making more money and they are spending more money and everything is as good as the government says it is, because we're not peddling fiction here, why are imports plunging along with personal consumption expenditures? Personal consumption expenditures are what everything you buy is. That's what you're spending money on. That's 70% roughly of economic growth. So if you're going to create a growing economy in a consumption-based economy where 70% of what drives the economy is what you're spending, that's not a good sign. And by the way, you notice that the only time that those lines go negative is during a recession, either 2001 or in 2007, 8. And by the way, after, just so you know this, after the seminar today, I'll be packaging this PowerPoint up and sending it to everybody, so you'll have a link for it. This is retail sales. See the problem here? Retail sales make up 40% of personal consumption expenditures. This is the stuff you're buying at the store, the stuff you're buying online at Amazon. This is the stuff you're buying through eBay, whatever it is. This is your retail sales, Walmart, Target. Again, that's 40% of personal consumption expenditures, which is 70% roughly of the overall economy. And by the way, just over the last Friday, we got the retail sales numbers down again. This chart is not updated for last week. It's actually worse than this. Not by much, but a little bit. When we take a look at things that drive economic growth, one of the things that people look at are leading economic indicators. I will qualify this by saying two things. Post-2008, after the financial crisis, the LEI index, the leading economic indicator index, was modified to overstate economic growth. And this is why you'll notice in the beginning part of the chart on the left, the correlation is almost exact. And what you will notice is that post the financial crisis, there's this gap now between the two lines. And that's because they changed the way they calculate the index to be more optimistic. But it's still turning lower. And the point is that when it declines, typically you have a much weaker economic environment. This is also a look at the leading economic indicators, but a little bit different look. If you take the coincident, there's 3 indicators that make up the leading economic indicator index. There's the index, the coincident index, and the lagging index, which takes 3 different views of the same bit of data. If you take the coincident and the lagging indexes and use them like a book-to-bill ratio, which is basically saying, how much are you, what's actually happening versus what do we think is going to happen. Whenever this quote-unquote book-to-bill ratio is below 0, you have basically been in an economic recession previously. This indicator has never been at this level where you are not in a recession. This last chart is corporate profits. Corporate profits are the lifeblood of the economy. The stock market is a reflection of an investing into a company as a shareholder for an expectation to receive a pro rata share of corporate profits in the future. Corporate profits are a direct reflection of economic growth, of the economy. Because what you spend and what you consume is where companies derive their profits from, right? I mean, if I'm Target, where do my profits come from? That's what you come buy from my store. If I'm any business, my profits come from my customers. So if economic growth is growing, it cannot grow faster than corporate profits for very long because they are tied together. Corporate profits cannot outpace economic growth for an extended period of time. There could be times where we can have corporate profit growth growing faster than the economy, especially during a recovery, like following 2008. After the big blowout, you're going to have an immediate recovery of profitability because of simply you're going from 0 back up to a growth rate. So your growth rates of profits are going to be very quick during a recovery, but long term, if we scale it out long term and look at it over time, go back to 1900, the stock market has risen, not counting dividends, has risen about 6% annualized since 1900. Economic growth, on average, about 6%. Not surprising, exactly the way it should be. But the point here is that corporate profits are now on the decline. Going back to 1900, whenever you have had a decline in corporate profits, 81% of the time, it's been followed by a recession. Corporate profitabilities begin to decline because as corporate profits decline, the decline in corporate profits are telling you that the economy is getting weaker, consumption is declining, and it's being reflected into corporate profits. 81% of the time, it's been followed by a recession. What about the other 19%? The offsetting factor, the other 19% of the time, you had a decline in corporate profits that were then followed by a reacceleration in profits. Every one of those situations coincided with Federal Reserve interventions. Either we built the Hoover Dam, did something from government spending-wise that created a short-term recovery and economic activity, but it was just that. It was a short-term recovery. In every situation, 100% of the time, when you've had a decline in corporate profits, even with a temporary reacceleration of those profits, you have eventually wound up very shortly thereafter in a recession. We now have currently declining corporate profits, but we have the Federal Reserve, European Central Bank, Bank of China, Bank of Japan, all doing everything they can. They are throwing liquidity and negative interest rates, and you pick the boat, they just chunked it into the ocean. everything they can to help try to keep the economies globally afloat. The problem is that everything they're doing now is a temporary fix. It's not solving the underlying problem. And the underlying problem is a very nasty four-letter word: debt. And until you start to deal with the debt issue, you cannot create long-term economic prosperity.